Remember, the last time that we heard from Jerome Powell was back at the end of September, the end of August, talking at the Jackson Hole Summit saying, well, we're going to be hiking rates a lot more aggressively than what the markets had thought, and talking about the fact that what was most important, even despite a slowdown in the economy to below trend growth, they were okay with that as long as they got inflation under control. So the issue today is 75 basis points or 100 basis points. Wells Fargo out this morning said, man, just rip the Band-Aid off, do 150 basis points, get it over with. That's not going to happen. But that's kind of where we are. People are just getting frustrated right now with markets. Here's the important thing about all of this, though. The Fed will come out today, probably raise rates by 75 basis points. They'll also maintain that language of fighting inflation. That's going to be their real focus for the time being. The dot plot, which will come out this afternoon as well. Now, this is the voting members all suggesting their points, right? So that's all the little dots that are on the screen. That should show you basically that the Fed is planning on raising rates to 4 to 4.5%. Into 2023 and then staying there until 2024. Now, why is that important is because Goldman Sachs and others are all expecting the Fed to start cutting rates by May of 23, and the Fed is not saying that at all. So again, markets keep tending to get ahead of the Fed, and that's where, as we talked about a little bit yesterday, going into the Jackson Hole Summit, Jerome Powell scrapped his speech and came out with a short prepared statement, basically smacking the market upside the head, saying, hey, listen to what I'm telling you. Listen to the words coming out of my mouth. That's what Jerome Powell is trying to tell the markets. And markets did listen. And of course, we did have that sell-off. Now, that was following that very sharp rally that we had going back, in June and July and early August. Completely reversed the majority of that. Now, markets yesterday did sell off a bit in anticipation of today's announcement. Good news is, though, of course, markets continue to hold that support line going back to May lows. So we haven't violated that yet, and we're still trying to hold on that support. So markets are kind of trying to figure out what the Fed's going to do. We continue to kind of push down on these oversold conditions. Now, markets tend to rally the day of and the day after the Fed announcement. So, we'll see if we can get a little bit of a lift here later this afternoon after the Fed announcement. If they come out, kind of just stay status quo, wouldn't surprise me to see markets kind of rally just a bit. Again, kind of start building in hopes that, okay, they got another 75 basis points out of the way. We're closer to terminal rate. That's where they're going to stop. Maybe they'll stop sooner, potentially get some of that kind of bullish attitude coming in the markets, get a little bit of a lift today. Certainly just be a bit of a relief after this kind of just, exacerbated selling. We've talked about this previously back in this July, August rally that we had. We talked about buying stampedes at the time and saying that we've had a very long buying stampede in the markets. Well, now we've got a fairly long selling stampede in the market as well. So again, markets always kind of ebb and flow. And I know that during these kind of sell-offs, you kind of get frustrated. It's like, oh, market's never going up again. I know that's easy to kind of fall into that trap. Just remember, markets do kind of ebb and flow over time. So again, you're going to have rallies, you're going to have declines, you're going to have rallies, declines. Now, the volatility is certainly a lot bigger this year than what we were accustomed to over the last couple of years, but that's not surprising either. Periods, and we wrote articles about this on our website. If you go to our website and Google volatility in the search bar, I wrote several articles talking about how periods of low volatility are followed by periods of higher volatility. And that's obviously what we have going on this year. So it's not fun at all, but that's just the way markets work. And we just need to understand that. It doesn't mean that you just kind of give up the ghost and quit investing altogether. It's just part of the cycle that we're in right now. We'll get through this, and things will get better on the other side. We just got to get through this. That's the big thing. And more importantly, get through this in one piece. That's even the bigger issue. So Danny Ratliff will be joining me this morning. We got a few topics to get through as well. So we'll talk a little bit more about the Federal Reserve this morning. But the other kind of important point here is I do want to talk very briefly about the bonds right now, because bonds are, and Jeff Gundlach yesterday, of course. Now, Jeff Gundlach is the CEO and head bond trader for DoubleLine, and of course, DoubleLine is one of the largest bond funds in the world. And Jeff Gundlach runs that, and generally he has a very good pulse on what's happening in the mortgage markets as well as corporate bond markets and treasury markets, noting yesterday that bonds are extremely cheap relative to stocks, and he's absolutely right about this. We've talked about this for a while. Bonds have been continuing to kind of build a base along this very oversold condition level that we've got, and bonds have been opening down in the morning, and there's been a good bit of buying happening in the bond market all day long. We're very close to triggering a buy signal as well. So one of the things that is always important, and I know people get frustrated with stuff, but in 2020, that was where we had, kind of negative energy prices, oil stocks under a tremendous amount of pressure. Nobody wanted to own energy stocks. Of course, that has turned out to be one of the best asset classes to be invested in. That's the way markets work. Bonds have had the biggest drawdown since 1798, something like that. So it's been a huge bear market for bonds this year. And as historically is always the case, one thing to remember is that when you have big bear markets in any asset class, that's generally a very good buying opportunity. So why will bonds go up eventually? That's because we're going to have much slower rates of economic growth. The Fed's already told you that's what they want. They're going to bring down inflation. They're telling you exactly what their plan is, and if inflation comes down and economic growth slows, bond yields go up. It's just a function of where money flows to in the economy, but yields and inflation have a very close correlation with each other long term. So if the Fed's whole target is to bring down inflation, what asset class is going to do better in falling inflationary environment? That's bonds, right? So just, always try to remember that, in the heat of the moment, things certainly can suck, and that's really been the market this entire year. There's been nothing fun about the market this year, but these very oversold opportunities that exist provide really great buying opportunities for the future. But again, if you wait to look back at the fact and go, bonds did great last year, well, you kind of missed it. That's the whole point. So, be careful. But Jeff Gundlach making some really good points this morning about relative to stocks, bonds are trading extremely cheaply. And again, if the Fed does make a policy mistake, which is a rising possibility now, because as they more aggressively hike rates, that really brings in the risks, as we talked about yesterday, of a policy mistake. In a policy mistake, money will rotate from risk on assets, stocks, into risk off assets, which are treasuries. So just keep that in mind. All right, take a quick break. We're going to come back. Lots of stuff to get into this morning with Danny Ratliff, who'll be joining me here in just 1 second. But be sure to get by the website. Our latest blog post is out yesterday. Michael Leibowitz's blog post is out today. That's on the website right now under the Insights tab, realinvestmentadvice.com. Stick around. We'll be right back for more of The Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If your portfolio looks more like a horror show, you won't want to miss our next Candid Coffee on dealing with bloody markets. No tricks, just treats. From Richard Rosso and Danny Ratliff with some not-so-spooky ideas to budgeting and how to maximize your cash. Don't be spooked by markets or Danny's bathroom on our next Candid Coffee, Saturday, October 1st. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso, realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning, 6:17. Danny Ratliff joining this morning. Danny, good morning. How are you, sir?
Hey, good morning. Doing great. How about you?
It's doing good. It's doing good. You know what happens? You know diets, right? The problem with diets is that you when you're on a diet, you deprive yourself of stuff that you really want, right? And then you build up a craving for that thing you're depriving yourself of, right? I don't know if you saw this in the media yesterday. The COO of Beyond Meat. Of course, this is the meat substitute, winds up biting the nose of a guy he gets in a scuffle with. So,
yeah, how ironic.
So, got to keep those cravings under control, right? That's all I'm saying.
It's turning people to cannibalism.
I know it's funny because all the images that are running around. There's a meme running around, of course, of this. It's Hannibal Lecter with the mask on.
Oh man, that's hilarious.
Anyway, lots of stuff to get into this morning. Just talking a little bit about the FOMC a few minutes ago, and that rate hike announcement will come out this afternoon. Again, kind of the large expectation of this is a 75 basis point hike. Fed could surprise, of course, and do a 1% hike. But with I don't suspect that'll happen. I'm not saying it can't happen. I'm not saying it won't happen. But there's already signs that inflationary pressures are starting to come down. So probably I would expect that the Fed is going to kind of, even hiking at 75 basis points is still very hawkish, and that's still aggressive. That's an aggressive rate hike. So, but with signs of inflationary pressures starting to ease in the economy, we're seeing rental rates starting to come down. One of the big problems coming up is that rental rates are going to plummet here in the course of the next couple of years because there's a huge oversupply of rental properties getting built right now. Everybody's running out building multifamily apartments. And there's, of course, as always, we saw this back a couple of years ago with commercial real estate in Houston. We had like 6 million extra square feet in Houston, and that collapsed pretty quickly. So, but it's always the base case of supply and demand and economics. And right now, there's a huge amount of apartments, multifamily units getting built right now. That's going to lead to a supply glut. Then, of course, once you have a supply glut, then prices are going to fall. So we're going to see a good bit of that change here over the course of the next couple of months. But that's going to bring down, again, that homeowner's equivalent rent. Part of that is an equation based on home prices, what homeowners can think they can rent their house out for, and then also some of the actual rental data. So as that rental data starts to decline, we're going to start to see one of the largest components of inflation decline, which is that homeowner's equivalent rent. And that drives a very large chunk of the inflation calculation. So very likely the Fed Fed's aware of this, by the way. I'm not telling you anything they don't know. But so that's why we think it's a real probability that they're going to stay with 75 basis points today, probably 50 basis points at the next two meetings. And again, what their dot plot's going to show is probably a terminal rate between 4 and 4.25% going into next year. So that's going to be the question. Now the big issue for the markets is when is the Fed going to reverse their rate hikes and start doing a rate reduction. A lot of Wall Street currently expecting them to start doing that in 2023, by mid-2023. The Fed's telling you that's not going to happen until the earliest 2024. But of course, that's all subject to recession issues, credit events, et cetera. So if something like that happens, then they will be cutting rates sooner than what their dot plot says. So that's kind of the brief overview. Danny, what are your thoughts real quick before we move on?
Well, I think it's interesting to note, and right now we've discussed that there hasn't been any big credit events as of yet. So as you mentioned, the exogenous events, we have not seen those occur. Now, higher interest rates could certainly expose those types of problems. And I think what most people are struggling with is, like you mentioned earlier last segment, okay, energy was not in vogue, and then it became one of the best asset classes. Same thing goes for bonds. And so many people are struggling with the idea of, where do you invest in bonds? Rates are going to continue to go higher and higher. I think everybody's waiting for the meeting minutes today. Okay, what does Jerome Powell say, beyond just what is the rate hike? Right. And so you mentioned this being a good investment. What do you see this? How do you see this playing out?
Well, the issues that we were talking about in the first segment a little bit, Jeff Gunlight just talking about how bonds are extremely cheap relative to equities. And he's right. You've had a major bear market in bonds. Yields are up. And for the first time in, the last, 5, 6, 7, 8 years, there is now an alternative. TINA was the big thing. There is no alternative. Well, there is now an alternative, which is bonds. And, people are going to make a lot of mistakes here. They're going to do a couple of things. One, they're going to, people are going to run out by 2-year treasuries, go, I'm getting 4% on treasuries, and that's great. And then the market's going to correct. You're going to have a bear market bottom and stocks. Stocks are going to start to rally fairly sharply. And then you're going to be trying to get out of your treasuries to go back and buy stocks. So you completely miss the whole turn. So if you're going to buy treasury money, that's fine. Just make sure you're willing to hold it till maturity and collect your 4%. Be happy about it. That's fine. Be as always happens with individuals, just a year or so ago, people were running out and buying, treasury inflation protected bonds. And those yields have just continued to drop. The price of tips have dropped. It's been pretty much a terrible investment for people. People running out to buy gold. That's not worked out well, in anticipation of inflation. So, things don't always seem as simple as they are on the surface. And again, you buying, it's kind of like, being on that diet, right? It's like, hey, I'll go out and I'll get off my vegan diet and go eat a steak real quick. There's consequences for that. Generally, your body doesn't like that initially. So, this is what's going to happen with markets. So just make sure that whatever moves you make, you're willing to stick with that move until maturity, because that's where you're going to be hanging out. But on the longer end of the curve, which is what the Fed does not control, that's where the real opportunity lies. So that's where 10-year treasuries, 30-year treasuries are going to make a lot of money over the course of the next several years as inflation comes down, economic growth slows, you get into a recession. That's where you want to be headed. You don't want to be on the short end of the curve, because as the short end of the curve uninverts, the long end prices will go up as yields drop. And so you want to be on the long end of the curve, not the short end of the curve, because that's where you're going to make all your money. If you're trapped in the 2-year or under range, yes, you'll get your 4%, but you're going to see a big capital appreciation in long duration bonds, and you're not going to get that. And you're going to go, what did I just do with my money?
Well, but I think that's okay to be in short as long as you understand, like you said, you may be stuck in it for a moment. And that's kind of the idea behind it, because we can, okay, where else do you put funds right now, especially if you want flexibility for the future? So the long end of the curve, I think one of the things that's interesting that I think many people have struggled with is that when you're investing, and what the Fed is doing today, what impact does that have on the long end of the curve? So, for instance, like a long-term bond.
Well, the Fed has no impact on that.
Yeah, it's more going to be based on the economy and inflation.
Right, yeah. So that's what I'm saying is like the only thing the Fed controls is the short end of the curve.
Yeah.
So here, let's do an example, right? So if I'm buying bonds right now, I'm not buying 2 years, I'm buying 3-month bonds, right? Correct. Because I can just roll those every 3 months and I don't have to worry about getting trapped into a long duration bond. So I don't want to be trapped in a 2-year bond at 4% if we get into a recession. Because at that point, the Fed's going to be cutting rates, so that yield is going to be stuck there. But as they cut rates, the money's going to flow into the long end of the bond curve because inflation and economic growth is slowing, and money's moving into safety and long duration. So that's where all your so you're going to make 30 to 40% in capital appreciation on your long end of your bond curve, and you're not going to make anything on your short end. So that's what I'm saying. You want to be real careful not to trap yourself chasing yield. And this is all people are doing right now. It's like, oh, I'm just going to go buy a 2-year treasury, screw everything else. I'm going to go do that. That's fine. You're chasing yield, but you're going to put yourself in a really bad box because you're not going to be able to make that switch in time to catch the other end of the cycle when it occurs, because it'll occur very quickly.
But that could be okay too if you miss part of the downturn and you say, hey, you know what? I'm going to wait for a confirmation of the trend.
Yeah, but you won't do that. No. I mean, this is why people are coming to us now that haven't been in the market since 2009, right? Yeah. And this is, look, it's all psychological. What'll happen is we come out of this bear market and go, oh, well, this is a rally. It'll go back down. I'll sell my bonds and I'll buy the dip. And then the market's going to keep going. The Fed's going to cut rates. They're going to do QE. Stocks are going to keep going. And that pullback you keep looking for isn't going to happen.
Yeah.
Not to a degree that you're comfortable in buying it. Everything will be back to it's overbought, it's extended, it's overvalued, and, you know.
Well, the problem is with the pullback, nobody wants to buy that anyways.
Right. So that's what I'm saying. It's all psychological.
Yeah.
But the whole point is there's nothing wrong with buying 2-year treasuries. Just don't lock yourself in that position, because when the time comes to make the switch, you're going to have to make that switch regardless of what your cost basis is. You know, if you have to sell it at a loss, you got to sell it at a loss. That's just going to be part of the deal to make the switch.
Yeah, it makes money management just a little bit harder.
Yeah, absolutely. But again, it's just, these are those psychological impacts that people get themselves into, and the psychological kind of behavioral traps, right? It's like, oh, I'm here, I'm good for right now. Then the market takes off. Oh, it's just a rally. It'll fail and it's going to go low, or I'm good where I am. And then it keeps going, and you kind of keep watching the market. And now you're at this 4% yield, and even though you said you were okay at 4%, as long as I get 4% of my money, I hear this all the time. If I can just get 4% of my money, I'm good. Yeah, that's fine until the market's up 20, and then you're going, why didn't I get that 20? Yeah. Right? That's just human nature.
No, it is, and I think that's the difficult aspect of it all. Everybody says that 4% is good until it's not. Mm-hmm. And, thinking about market cycles and really where we are and where we're going, I think most people are expecting to find out, oh, look, everything is great. We get this great presentation from the Fed that says how strong the economy is, and then the market goes up, when it's going to be the opposite.
Right.
The Fed's going to be behind the ball. We're going to find out the market's already running. We've already hit a bottom. Yep. And then they're going to come out and say, hey, guys, we're going to switch courses.
Yeah, exactly. Now, all that's assuming you don't have a credit event, But assuming that, you don't have that, and hopefully we won't, right? We don't want a credit-related event. Just there's a risk of it because of monetary policy. But Danny's absolutely right. Market's always going to lead the markets. So, all right, quick break. Come back on the other side. We'll pick up with, kind of the markets, money, some other topics. Don't go away. Right here for the Real Investment Show. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
If your portfolio looks more like a horror show, you won't want to miss our next Candid Coffee on dealing with bloody markets. No tricks, just treats. From Richard Rosso and Danny Ratliff with some not-so-spooky ideas to budgeting and how to maximize your cash. Don't be spooked by markets or Danny's bathroom on our next Candid Coffee, Saturday, October 1st. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, Another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
If you take all of the marshmallows out of a box of Lucky Charms, are you left with a box of Purina Cat Chow? Pretty much.
Pretty much.
Yes.
Yeah.
See, as you get older, you move away from those. Remember, because when you were growing up, it was Captain Crunch, it was Fruit Loops, Apple Jacks,
Alphabets.
and now it's Raisin Bran, Cheerios, raw oatmeal.
The Real Investment Show podcast
Once you move out of sugary cereals, your life is pretty much over.
at realinvestmentadvice.com.
I don't really understand Lucky Charms.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
If your portfolio looks more like a horror show, you won't want to miss our next Candid Coffee on dealing with volatile markets from Richard Rosso and Danny Ratliff, Saturday, October 1st. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome to the show this morning, or say back to the show this morning. Danny Ratliff joining me as well. Of course, one of the things that has an rising interest rates has an impact on not just the bond market is people with pensions that have a lump sum option available to them. And here in Houston, a lot of oil companies, there's not that many companies anymore. The number of companies that provide pensions to their workers is a dwindling number, and that's been a thing in process now for the last 20 years as 401ks became a more viable option for employees, and companies go, oh wait, I can take all that liability off my books and shove all the liability for retirement saving onto the individual. Good with that, right? and they did, and 401ks have worked out horribly for most Americans, but the pensions, while they are slowly going away, they are still there. And one of the issues, or one of the choices that you have with a pension, if you're not familiar with this, is you can either take a stream of payments over time when you retire, and your pension kicks in, you'll get a monthly check for the rest of your life, and potentially, depending on how you set it up, you have an option for you and your spouse, those type of things, right? So you pick your payment option, you get a payment stream for the rest of your life. The other option, and the option that most advisors will tell you to take because they want your money to manage, is the lump sum option. And the issue with the lump sum option is as interest rates go up, there's a discounted value of that future stream of payments that is calculated into the lump sum you get today. It's kind of like, you see people win the lottery. And when you win the lottery, they say, you won a $1 million lottery and you can have, $10,000 a year for the rest of your life. And if you live long enough, you get more than $1 million. Or you can have 60% of that value today. And that's that discounted value for taking all your payments today. You take a discount. That's the way lump sums work. for the last decade, people have come to us and they're like, what should I do? Should I do the lump sum or should I do the stream of annuity payments? And the answer has been very simple, the stream of annuity payments, because those payments were high enough they couldn't be replaced by a secondary market instrument. So you were better off staying with, the ExxonMobil pension or whatever and taking that stream of payments. However, that is now changing.
Well, I can combat that just a little bit, right?
Sure.
So a lot of people are taking lump sums or historically have because we're looking at the present value interest rate. And so when we talk about the pension, what they're actually going to be able to pay you, it's a lot less when interest rates are low because they're encouraging you to take that lump sum.
Right.
So those lump sums are much higher. So now what we're seeing is that a lot of people they're accelerating retirement because they know right now, they're looking at the numbers, they're doing the math and looking at the interest rate calculations. And it is becoming really detrimental if you want to take the lump sum because those lump sums are going to start declining. And usually what happens is these corporations, they have a present value interest rate. There's several segments that they look at. They get these numbers from the IRS and those numbers are declining on a quarterly basis. So as we see these numbers decline, people are starting to become incentivized to go ahead and take those funds out if you're looking to take the lump sum. And look, we can make a pros and cons list for both where, okay, pros, you want to take the lump sum, you retain access to the capital, there's more flexibility with it. You're going to be able to do what you want. Now, the cons are you're not going to be able to create that income stream, or at least historically you are not able to, with those same funds as you could with the annuity. So remember, when interest rates are very low, they want to incentivize you to take that lump sum. So that lump sum payment will go up the lower interest rates go because they can't go out and buy treasuries or whatever else they're going to buy that are going to offset that. And historically, what they're trying to do is they'd like to go buy treasuries at 5% and pay you out at 4%.
Sure.
And make a little bit more money. The pension fund is more solvent. That has not been the environment that we've been in. Now, with interest rates rising, we're seeing that lump sum decline. We're seeing the pension payout actually increase. So where they're getting more comfortable paying you more and looking at life expectancy. And so people are receiving more. But here's the kicker, and we did touch on this briefly last week, and we've got a lot of questions on it. So we want to address this a little bit more, is that the kicker now is that we can actually go out on the secondary market and find other types of investments that will have that same type of income stream, but higher. And you still retain control. You have some type of cash refund. Lance, the biggest problem with most of these pensions is you don't have a lot of options. You have a single life option, meaning that you will get this payment for the remainder of your life. If you pass, or if you receive one payment and pass, those funds are gone, which is one of the biggest cons. And I think that's why many people elect to take the lump sum. Now, there's also a joint life. So you and your spouse, you would be able to receive that for the remainder of either one of your lives. So both of your lives. If you pass, your wife or your husband, they're still here. They're going to get those payments until they pass. So
but then it's over.
It's over.
And if you retire, the next day you take your retirement trip, and both of you are killed in a car wreck,
that's right.
It's over. And so nothing to go to your children.
That's
or your
right.
estate.
Now, you can do period certains where you'll have a 5-year, 10-year, 15, 20-year period certain, meaning that during that time frame, if you were to pass, then your beneficiary would receive those payments for the remainder of that time frame. So everybody looks at this a little bit differently. It's going to be contingent on, life expectancy, the health of you and your spouse, what other type of income you have coming in. But one of the bigger caveats that we found recently is that now we're able to go out, purchase a joint life if you have a partner, and purchase some type of joint life annuity, and then turn around and have something called a cash refund on it that is going to allow you or your heirs to benefit if you were to pass. So similar to taking the lump sum, but actually being able to utilize the best of both worlds in the sense that, okay, you take the lump sum because you want to retain flexibility. You want to make sure that you have these, should that instance or that example Lance just used, if that were to occur, that your family gets those funds. Well, so now we're able to do kind of the best of both worlds.
Right.
And that's what the beauty of this current interest rate environment is.
Yeah, exactly. And that's what I'm saying is for the first time that we've had in a decade, you can actually, make a valid recommendation. Because again, a lot of people were saying, a lot of advisors love pensions because they're like, yeah, take the lump sum, give it to me, I'll invest it for you. And the investments don't turn out well, right?
Yeah.
And, it doesn't, create that opportunity. And the long time, the big challenge over the last decade has been saying, hey, with reasonably clean conscience, saying, yeah, take the lump sum and invest it in the stock market because you're going to make more money. And that really hasn't been the case. And, for most people, right? You take a look at the average investment return. But now you can actually do that with certainty about what that money is going to generate. And again, there's 2 points to any retirement plan, which is you have your investable assets that you're investing in markets at risk. And then you have these other streams of income that are securing your retirement in terms of income, being able to pay your bills, those type of things. And that's part of what the good financial planning part does, as well as determining what that base income is needed just to fund your lifestyle. Then that allows you to put the rest of the money at risk to create that additional rate of return that you're looking for the luxuries in life.
Well, that's right, Lance. And I think the bigger thing here is that understand that you need to do a financial plan. You need to understand, okay, what are your scenarios? What if you take the lump sum? What does that look like? What if you take the pension? And then there could be a combination of the two. Some of these actually will allow you to take a lump sum for a portion and then retain a pension for the other portion, where maybe it's half of it, a quarter of it, or even 75%. So that's another nice kind of aspect that some of these companies will allow for. But a plan needs to be done. Lance, a lot of times we see that plans work both ways. You could take the lump sum or you could take the pension. Now with, kind of what we've seen over the last month or two, that's changed a little bit as far as what we can actually do with the funds outside of it versus just saying, hey, let's take the lump sum and invest it. But there are times that it's pretty cut and dry, and it may be because we don't have enough non-discretionary income coming in to meet those non-discretionary expenses. And I think that's the big aspect. You want to create that floor where you say, hey, you know what? I don't have to sweat this. I know exactly what I need to keep a roof over my head, to be clothed, fed, protected, and let's meet those expenses. There's certain ways you can do that. Now, a lot of people, that's with Social Security, that may be with pension income or other income that you're generating outside of your typical 401k or other types of investments. And look, this may not pertain to a lot of you guys out there. I know pensions they're kind of like the dinosaur. They've been extinct, with the advent of the 401k. Fewer and fewer companies are using these. But if you have them, this is a very important time to kind of start to understand, what does that mean for you? What does it look like? And, Lance, one thing that we're seeing, we get a lot of phone calls about, hey, I need to go and take this pension lump sum because these rates are changing. I'm going to lose hundreds of thousands of dollars. And while that's true, sometimes you just can't retire. You're not there yet. And so trying to find a job in this type of market environment could be a little more difficult than usual.
That's right. So just real quick, though, before we get to the break, again, there's annuity options finally actually are valid, but then there's other aspects to that as well, that because interest rates have come up, we're seeing better payouts on really a lot of even whole life policies on the cash value that they pay. Those rates are starting to come up. So, again, as we talked about earlier, for the first time, there is an alternative, to cash. And there's actually becoming an alternative to stocks as well in other vehicles. But this is why, it's always important to kind of review all of these different tools that are available to you in the toolbox and saying, what's the best mix of these tools to get my particular, retirement house built.
Well, it has to be holistic. You have to look at each and every one of these options, understand, all the assets that you have, take an inventory, then make sure you understand and your advisor understands exactly how they work together, because that's the important part. I see too many times, we talked about, I brought up the 4-letter word annuity, and, people are like, oh my gosh, this is terrible. We'll never talk to somebody because they do this. But the problem is many times just because they've been sold. They don't understand the big picture, and that's where we get in trouble. So make sure you plan for them. We always believe annuities should be planned, not sold. Same thing with any type of insurance.
Yeah, that's why I own an annuity, because we're in a judgment happy environment. So
yeah,
it's a great tool to have. You know what you're using it for. All right, quick break. We'll be back. Wrap up the show with Danny Ratliff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If your portfolio looks more like a horror show, you won't want to miss our next Candid Coffee on dealing with bloody markets. No tricks, just treats. From Richard Rosso and Danny Ratliff with some not-so-spooky ideas to budgeting and how to maximize your cash. Don't be spooked by markets or Danny's bathroom on our next Candid Coffee, Saturday, October 1st. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso, realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show, of course. As one thing we always find out after the fact is with government programs, particularly aid programs and packages that are just quickly thrown together without any real thought, have a lot of unintended consequences. And of course, we go back to 2020 and we talk about the, everything from the direct checks to households that have now sparked, this massive inflation in the economy, and, the PPP programs and the payroll protection programs and all the other assistance that was provided. We quickly threw this stuff together and said, hey, we just got to get this stuff out. People need help. We shut down the economy, got to send money. And the problem is these things are never done with any forethought about the consequences. As I said, send checks to households. That's awesome. If you do that with a shutdown economy, you're going to get inflation. Basic economics 101, supply and demand. Nobody really thought that through, right? So, the other side of this, of course, is also when you do this and you don't have any safeguards in place, well, people are pretty smart, right? And they say, nothing, if you want to find out if something's foolproof, hire a fool, right? So, people took a lot of advantage. We talked about on the show before is that people took all kinds of advantages of these programs, the extended unemployment benefits. People were just, piling in to claim unemployment benefits that were completely fraudulent. Mark Hicks, who is a rapper called Kafani, just sentenced to 7 years in prison. He is a career fraudster, by the way, and a rapper. At least he's got a twofer on his sheet, right? He's been sentenced to 7 years in prison for running an intricate scam in which he used stolen identities to apply for mortgages and then buy gold bars. Now, look, applying for a mortgage and getting approved, even using a stolen identity, is pretty elaborate because you need bank records, tax records, all that. So that is not an unsophisticated program he had going on. 48 in Minnesota have been charged with stealing $250 million from the pandemic aid programs. Again, just, this is, the ongoing problem with this. Again, payroll protection programs, small business loans, people were just running around creating businesses out of thin air and then applying for PPP, right? And we saw a lot of this was actually done by international citizens that were setting up programs to take payroll protection program funds back overseas. So again, just this is the problem. Of course, now this all becomes a liability of the taxpayer. And now that $5 trillion in debt, and this is, one of the interesting things is that when we talk about, this money that's out there, and, recently we wrote an article about the Biden administration talking about how they've reduced the deficit this year. And they didn't really reduce the deficit. What happened was we spent $5 trillion in pandemic, funds, and we didn't this year. So that surge in spending, that deficit, because how do we calculate the deficit? It's how much you spend by how much you bring in. Well, we're not spending what we spent in 2020 and 2021. So the revenue we have coming in relative to what we're spending has a reduced deficit, right? But you're actually spending more than we were pre-pandemic on a regular trend. But we're still stuck with all the debt, right? So the deficit, yes, what we're spending versus what we're bringing in is down from where it was in 2020, but we still have all the debt, right? And so taxpayers have to deal with all this, and that's going to be a long-term economic consequence as debt has to be serviced.
But we're spending less, Lance. I mean,
but on a linear trend, we're spending more.
No, I know. That's been the everybody's beating the drums that, hey, look at this, we're not spending as much as we previously were. Well, all the stimulus is gone, so of course you're not. Now, servicing that debt, how problematic is that going to be if interest rates continue to rise?
Well, it's already we've got some of the highest debt service ever right now because A, interest rates have gone up, and B, you have a tremendous amount more debt, right? We're at over $30 trillion in debt in a 22 plus trillion real, economy, right? So you're running in excess of 100% of debt to GDP, which, that's problematic long term. When you're over 100% of debt to GDP, that reduces your GDP growth by 1% annually, just from that alone. So, by the time we get through this pandemic-driven surge of artificial growth, and that all reverts back, as the Fed is talking about, they're going to be dealing with sub-trend or below-trend economic growth. So we're talking about economic growth that is going to be trending below 2% going forward. So even the Fed's long-term projections are at 1.8% right now, which is not the type of prosperous economy that you're looking for to grow wealth and economic equality, right? So,
yeah, well, even with what they did with artificial stimulation here, there was no equality here between wealth growth, right?
Right.
I mean, the rich got richer.
Well, it's because 90% of the people, the 90% of the market's owned by the top 10% of income earners.
Yeah.
So, and you can thank the Fed for that too. So
it's a vicious cycle. How do you get out of it?
Well, eventually the markets are going to eventually the Fed is going to have to stop intervening into markets with monetary accommodation. The market will reset, and then you'll get income inequality, because at that point, that 90% of the market that's owned by the top 10%, they're the ones that get impacted by a market that resets, right? The economy will go through a deep recession. You will have debt get blown out, right? And a lot of people are going to file for bankruptcy. Banks are going to take a big hit. You can't bail them out again. They're going to have to just deal with the consequences of issuing out loans that they shouldn't have loaned out. And they knew better to start with, but they did it. But you've got to allow that reversion in the economy. And then when you do that, you're going to get wealth equality, because, again, the people that are saddled with the debt, they're going to get expunged of a lot of that debt. They'll have an ability to reset their life, get back on financial track, get out from under that debt. The rich, who own all the debt and all the assets, they're going to take it on the chin on that side. So you're going to balance all this out. So but mind you, nobody wants to do that.
Yeah.
Right.
Well, but it's going to face some type of austerity at some point, which we can't do. We can, but we won't.
Japan's been messing with it for 30 years. So, my point is that it's not likely going to happen in our lifetime. These situations can stay this way. And again, Japan's a really good example of this. There's no incentive for the central banks to allow a reset in the markets.
Yeah.
Right.
No, that's true. I mean, they want to keep their job, and politicians want to stay in office. Absolutely not.
And the wealthy want to stay wealthy.
Yeah. And that's who keeps them in office.
It's who keeps them in office, right? So it's just the way it is, and this is why you're seeing this rising call for socialism. You're seeing a very frustrated younger population coming up, wanting opportunity, and they feel like they don't have an equal shot at it, and so they feel like the only answer is to have more socialistic policies, right? Free school, free healthcare, all these type of things, and that's all great. There's nothing wrong with that. I was listening to a guy on the internet a couple of days ago talking about how we're this rich country and we need to have socialized health care. Sounds great, except it doesn't work. If you want, the reason people fly to the U.S. to go to Memorial, down, in downtown Houston for their cancer care or heart care or whatever, because we have the very best doctors in the world and they're paid for it. You go to a socialized program, there's no incentive to have the best. everybody becomes average, and you get average care, and that's what you get in Europe. And that's interesting because my son went to Germany under this idea, is like, oh, I'll get free healthcare. He's now finding out that free healthcare really sucks. That's twice I've used that word today. Because like he's got a problem with his gallbladder. He goes to the doctor, and doctor looks at him, kind of eyeballs him, and says, "Here, yeah, take this medicine and call me in 3 weeks." Right? No MRIs, no nothing to see what the problem is, just the base solution.
Well, but even then, if he needed actual surgery on that, the problem is the waiting time for that. I mean, there's a lot of doctors in foreign countries that come here to actually pay out of pocket for surgery because they know, one, how long it will be, and two, they don't think it's worth it.
And that's also why you have two levels of healthcare. You have the public healthcare system in Europe, and you have the private that rich people pay for.
Yeah.
Right. So anyway, the point is, though, is that socialism sounds great. The consequences are it brings everything down to average, and that's what you get. And it's just, but again, nobody wants that to happen, right? There's all these calls for socialistic policies, but in reality, the people that control the economy, again, your politicians, your Fed officials, your central banks, the rich, they don't want that reset because it's not beneficial for them.
Well, and frankly, it's not beneficial for anybody, because if it truly happens, I mean, we're beginning to see the confirmation of what we've thought for a long time, right? We're seeing layoffs, but it's not those mass layoffs. It's more with, it's the white collar, it's the management. Yeah. And that's changed significantly from what we've seen in prior recessions. So does that change too, where it impacts everyone and then everybody feels it even more?
Yeah. Well, no, I mean, you're going to have, eventually at some point, layoffs are going to tick up sharply. That's just a function of where we're headed right now. It just hasn't yet.
Yeah.
And, so we'll, probably, 2 more sets of rate hikes. We get into 23, 2 more after this one. So, we get into 2023, you get a recession sometime in first, second quarter. That's where you see your layoffs pick up. You're going to see your unemployment rate will go up. You're probably talking 6 to 7% unemployment rate, somewhere north of 400,000 to 500,000 in unemployment claims. And that's where the Fed's going to realize they've made a policy mistake and start talking about cutting rates, starting back on QE, stopping QT. We're just not there yet. It's early.
Yeah. So. The problem is, do you actually give the system a chance to cleanse?
No, of course not. Yeah. That's while we all know that's what should happen, nobody, as I said, nobody wants it to happen, right? And nobody will let it happen because, again, from the Fed's point of view, if you allow the system to reset, which would be healthy, your major banks would go out of business. The average person would be in bankruptcy. And while that would be great long term, nobody is willing to go through that pain to allow that structure to happen. And again, so that's why you just keep repeating the process over and over again. So, but we'll have a good bull market out of it. So there you go.
That's all that matters, Lance.
Wraps up the show. Well, for the 10% that own 90%, that's all that matters.
Yep.
All right, wraps up the show for the day. Be back tomorrow with Michael Leibowitz. We'll obviously be covering everything the Fed says this afternoon, reviewing what's happening with the markets, where all this is heading to, and what happens next. That'll be on tomorrow's edition of the Real Investment Show in the morning. Stick around, 3 minutes on markets and money. Be up here shortly.
It's a rich man's world.